You're sitting at your kitchen table on a quiet Saturday morning. You have a fresh cup of coffee, your laptop is open, and you are doing your monthly financial review. For the last few years, you've been incredibly disciplined. You saw the inflation coming, you saw the oil shocks hitting the global economy, and you decided you weren't going to be a victim. You did your research, you looked for a safe haven, and you found what looked like the perfect government-backed loophole. You bought sovereign gold bonds. You bought them on the secondary market because you wanted a discount and you liked the liquidity. You felt smart. You felt protected. You read the official brochures that promised you a 2.5% interest rate, tracking the price of gold, and best of all, the absolute holy grail of investing, it was completely tax-free upon maturity. You were doing everything exactly right. You were playing by the rules they gave you. And then you get an email from your brokerage, or you see a frantic headline on a financial news site. The date is April 1st, 2026, and it's not an April Fool's joke. The government just casually, quietly, and retroactively changed the rules. That tax-free maturity benefit you were banking on? It's gone for anyone who bought on the secondary market. Suddenly, a massive chunk of your hard-earned profit has been seized by a new capital gains tax that didn't even exist when you made the investment. You just stare at the screen. Your chest gets tight. It isn't even just about the money. It's about the profound, deeply frustrating sense of betrayal. You realize that you are playing a game where the referee is actively moving the goalposts while the ball is in the air. Your friend here, Karen. Money is simple on paper, complicated in real life. And honestly, watching the government change the rules of the game right in the middle of the match is one of the most frustrating things I study. I spend a ridiculous amount of time looking at how financial systems are designed, and the one universal truth I keep coming back to was this. The system is absolutely terrified of a middle class that actually knows how to build wealth. What just happened in the Indian financial markets with the sovereign gold bond tax rules is not just a localized regulatory update. It is a massive, blaring siren. It is a global case study in what I call the regulatory rug pull. Whether you live in Mumbai, London, or Texas, you need to pay very close attention to what just happened, because governments all over the world are currently drowning in debt, crushed by the macroeconomic weight of the 2026 oil crisis. And when governments run out of money, they don't tighten their belts. They look at your portfolio, they find the loopholes you are using to survive, and they close them. Today, we are going to tear down the illusion of the safe government investment. We are going to look at the exact anatomy of the SGB tax trap, dissect why the secondary market was targeted, and explain the terrifying concept of legislative risk that is silently sitting in your retirement accounts right now. Most importantly, we are going to build a defensive strategy so you can diversify your tax risk and protect your wealth from the very institutions that promised to keep it safe. Grab your coffee. We have a lot of structural illusions to dismantle today. Before we can talk about the trap, we have to talk about the bait. We have to understand why millions of incredibly smart, rational investors flooded into sovereign gold bonds in the first place. To do that, you have to look at the psychological state of the middle class over the last 5 years. We have been absolutely battered. We survived a pandemic, we survived massive supply chain breakdowns, and now in 2026, we are living through a historic energy shock that is driving the price of literally everything through the roof. When inflation is raging, the cash sitting in your savings account is actively melting. It is losing its purchasing power every single day. So human instinct kicks in. You look for a safe haven, and for thousands of years, the ultimate safe haven has been gold. But buying physical gold is a massive hassle. If you buy gold coins or bars, you have to physically store them. You have to buy a safe or pay for a safety deposit box at a bank. You have to worry about theft. You have to worry about the dealer charging you a massive premium when you buy it and a massive discount when you try to sell it. It is clunky, high friction, and stressful. Enter the government with a brilliant, shiny solution, the sovereign gold bond. The pitch was an absolute masterpiece of financial marketing. The government said, hey, don't buy physical gold, buy these digital bonds from us. They are backed by the sovereign guarantee of the state. There is no risk of theft. You don't need a safe. Even better, we will pay you a guaranteed 2.5% interest rate every year just for holding them. And the absolute best part? If you hold them until maturity, you pay zero capital gains tax on your profit. It was irresistible. It was the perfect financial product. It offered the safety of gold, the yield of a bond, the convenience of a digital asset, and the ultimate middle-class fantasy, legally paying zero taxes. People poured their life savings into these bonds. They structured their entire retirement plans around the assumption that this money was a tax-free fortress. They trusted the brochure. They trusted the sovereign guarantee. But here's the fundamental rule of personal finance that we all forget when we're desperate for a safe haven. If a financial product looks too good to be true, it's because the person selling it to you holds a hidden lever that they can pull the exact second it stops benefiting them. The SGB wasn't just a financial instrument, it was a honeypot. It was designed to pull massive amounts of liquid cash out of the private sector and hand it to the government to fund their deficits. And it worked perfectly, right up until the government realized they were leaving too much tax revenue on the table. So the honeypot is full. Millions of retail investors are sitting on highly profitable SGB portfolios because naturally, global chaos has driven the price of gold to record highs. And then April 1st, 2026 arrives. The government issues a new regulatory update. They don't do it with a massive press conference. They do it buried in the fine print of an income tax circular. The rule states that the tax-free maturity benefit, the core, foundational promise that convinced everyone to buy the bonds in the first place, is officially revoked for anyone who purchased the bonds on the secondary market. From now on, if you bought a bond from another investor on the exchange, rather than directly from the government's primary issuance, you will be subject to capital gains tax when the bond matures. Let's pause and appreciate the sheer breathtaking audacity of this move. Imagine you walk into a car dealership. The dealer sells you a car and signs a legally binding contract that says if you drive this car for 8 years, we will give you a full refund. 6 years later, you're driving down the highway and you get a text message from the dealer that says, hey, just kidding, we changed the rules. We're keeping 20% of your refund. You would sue them for breach of contract. You would call the police. But when the government does it, it's just called updating the tax code. Let's look at the math of how this devastates a portfolio. Let's say you bought an SGB on the secondary market a few years ago. Because gold has surged, your bond has generated a massive capital gain, say $10,000 in profit. You were planning to use that tax-free $10,000 to pay for your kids' college tuition or to cover a massive medical bill. Overnight, the government reaches into your account and retroactively assigns a capital gains tax liability to that profit. Depending on your tax bracket, you might suddenly owe $2,000 or $3,000 in taxes that you had absolutely no way of anticipating when you made the investment. Your yield is destroyed. Your financial planning is ruined. And the most infuriating part is that you didn't do anything wrong. You didn't cheat. You didn't use an offshore tax haven. You bought a government-sponsored, fully regulated asset exactly the way they told you to. They changed the rules because you started winning. The price of gold went up too much, the tax-free loophole became too lucrative for the middle class, and the government, desperate for revenue to combat their own inflation problems, simply decided to retroactively rewrite the contract.
You might be asking, why did they only target the secondary market? Why are the primary issue bonds still tax-free? This is where the psychology of the government becomes incredibly clear and incredibly cynical. We have to look at the concept of liquidity. When the government issues an SGB in the primary market, they're asking you to lock your money up for 8 years. 8 years is an eternity in finance. If you have a medical emergency in year 3 or you lose your job in year 4, you cannot easily go back to the government and ask for your money back. Your capital is trapped. The secondary market was the escape hatch. It allowed investors to buy and sell these bonds on the stock exchange before they matured. It provided liquidity. If you needed cash, you could sell your bond to another investor. If you missed the primary issuance window, you could buy a bond from someone else. The government hates liquidity when it doesn't benefit them. When you buy a bond directly from the government, you are handing them fresh capital to fund their budget deficits. They like that. They reward that behavior with a tax exemption. But when you buy a bond on the secondary market, you are giving your money to another citizen. The government doesn't get a fresh injection of cash. They view that transaction as useless to their immediate needs. So they decided to penalize it. They are effectively saying, if you want the tax break, you must surrender complete control of your capital to us for 8 years. If you desire the freedom and agility of the secondary market, we are going to punish you with a capital gains tax. It is a liquidity penalty. They are weaponizing the tax code to force citizens into locking up their wealth in illiquid, government-controlled assets. This is terrifying because it establishes a precedent. It proves that the government views the secondary market, the free market where citizens trade with each other, as an inherently taxable event, regardless of the original promises attached to the underlying asset. They lured people in with the promise of a tax-free safe haven, and once the secondary market became robust and heavily utilized, they slammed the door shut to trap the revenue. What happened with the SGBs brings us to a concept that is almost never discussed in mainstream personal finance, but it is currently the single greatest threat to your retirement. It is called legislative risk. When you sit down with a financial advisor, they talk to you about all sorts of risks. They talk about market risk, the chance that the stock market crashes. They talk about inflation risk, the chance that your money loses its purchasing power. They talk about sequence of returns risk, but they rarely, if ever, talk about legislative risk. Legislative risk is the probability that a government will literally just change the law and destroy your financial strategy. We operate under this naive assumption that the tax code is a fixed, immutable law of nature. We assume that if the rules say something is tax-free today, it will be tax-free in 20 years when we retire. That is mathematically delusional. Governments are essentially massive, highly inefficient corporations that operate on a permanent deficit. They are constantly looking for new revenue streams. As populations age, as the silver tsunami hits the healthcare system, and as global oil shocks make infrastructure wildly expensive, governments are going to become desperate for cash. And when a government becomes desperate, they do not look at the billionaires. Billionaires have armies of lawyers, offshore trusts, and lobbying firms. They are too hard to tax. They look at you. They look at the upper middle class. They look at the people who have a few $100,000 saved up in fully compliant, easily trackable, highly visible government-sponsored accounts. You are the low-hanging fruit. The SGB rug pull is just a preview. It is a proof of concept. If they can retroactively change the tax-free status of a gold bond, what makes you think your other tax-advantaged accounts are safe?
I want you to think about this in the context of whatever country you live in. In the United States, we have the 401k and the Roth IRA. In the UK, it's the ISA. In Canada, it's the TFSA. Every single developed nation has a version of a tax-advantaged retirement account. And the pitch is always exactly the same as the SGB pitch. Lock your money up with us for decades, abide by our strict withdrawal rules, and we promise we will give you a massive tax break when you retire. Let's look at the Roth IRA in the U.S. You put after-tax money in, it grows tax-free, and the government promises that when you turn 59 and a half, you can pull all the money out completely tax-free. Millions of millennials and Gen Z are aggressively funding these accounts, banking on that exact promise for the year 2050 or 2060. But what happens in 2045 when the U.S. government realizes that the national debt is mathematically unsustainable and there are trillions of dollars sitting in Roth IRAs that they aren't allowed to tax? Do you honestly believe they will just shrug their shoulders, honor a promise made 40 years ago, and let that wealth walk out the door tax-free while the government defaults? Of course not. They will change the rules. They won't
outlaw the Roth IRA, that would cause a riot. They will just do a regulatory rug pull. They will pass a bill at 2 a.m. on a Friday that says Roth IRAs are still tax-free unless your total portfolio exceeds $500,000, in which case the excess is subject to a 15% wealth tax. Or they will say Roth withdrawals are tax-free, but they now count toward your provisional income, which makes your Social Security benefits 100% taxable. They will means test it. They will add a secondary clause. They will change the definition of tax-free to exclude the people who were actually successful at building wealth. This is the exact same playbook they just used on the SGB secondary market. They lured the capital in, trapped it, and then changed the definitions to extract the revenue. If your entire financial plan relies on a politician in 30 years honoring a tax loophole created today, you do not have a financial plan. You have a wish. Okay, you are probably feeling incredibly cynical right now. You might be thinking, well, if the government can just steal my money whenever they want, why should I even bother saving? Why don't I just spend it all today? Because giving up is exactly what the system hopes you will do. A nihilistic consumer is a profitable consumer. If you stop saving and start spending, you just hand your wealth to corporate America instead of the government. Either way, you lose. You cannot give up. You have to act like a highly defensive chief financial officer. You have to actively manage your legislative risk. And you do that through tax diversification. Most people understand asset diversification. You don't put all your money in one stock. You buy bonds, real estate, and index funds. But almost nobody practices tax diversification. They put 100% of their life savings into a single tax vehicle, like a traditional 401k or an SGB, and they cross their fingers that the tax code doesn't change. That is financial suicide. You must spread your wealth across different tax environments so that when the government inevitably changes the rules on one of them, your entire net worth isn't held hostage. Bucket 1, the tax-deferred bucket. This is your traditional 401k or IRA. You get the tax break today, but you promise to pay taxes when you pull the money out in retirement. You fund this up to the employer match because free money is free money, but you recognize that you are making a bet that tax rates will be lower in the future, which, given the massive global debt, is a highly risky bet. Bucket 2, the tax-free bucket. This is the Roth IRA, the HSA, or the primary issue SGB. You pay taxes today and you are promised tax-free growth. You fund this to hedge against future tax hikes. But as we just learned, you do not trust this bucket implicitly. You know the government might alter the deal later, so you do not put your entire net worth here. Bucket 3, the taxable brokerage bucket, the freedom account. This is the most underutilized, most important bucket for the modern middle class. A standard taxable brokerage account. No special tax advantages, no government lockup periods, no age restrictions. Yes, you have to pay capital gains taxes on your profits every year, but here's the massive, undeniable benefit. You have absolute liquidity and absolute control. If the government changes the rules tomorrow, you can sell your index funds on a Tuesday afternoon and move your cash. You're not trapped in an 8-year lockup. You're not waiting until you're 59 and a half. You're paying the capital gains tax, but you're buying freedom. In a world of infinite legislative risk, liquidity is the ultimate premium asset. You pay the tax to maintain your agility. Bucket 4, the hard assets. Finally, you must hold a percentage of your wealth outside the digital financial system entirely. Real estate, physical businesses, or even physical precious metals if you choose. Assets that require physical friction to seize or tax. If the government wants to tax your digital SGB, they just flip a switch in a database and the money disappears from your brokerage account. If the government wants to confiscate your physical property, they have to send a human being with a piece of paper to your front door. Friction is your friend.
There is a final lesson in the SGB tax trap, and it is about who you outsource your financial thinking to. For decades, we were trained to outsource our financial security to authority figures. We trusted the company pension. We trusted the Social Security Administration. We trusted the broker selling the government bond. We assumed that because an institution was large and official, it was looking out for our best interests. The April 2026 tax change proves that there are no benevolent institutions. There are only entities trying to optimize their own balance sheets. When the government realized the SGB secondary market was costing them tax revenue, they did not care about the retiree who bought the bond to pay for medical bills. They did not care about the broken promise. They cared about the deficit. You have to adopt this exact same ruthlessness when managing your own household. You cannot blindly trust a financial product just because it has a government stamp of approval. You have to read the fine print. You have to anticipate the rug pull. You have to ask yourself, if the rules of this investment changed overnight, would I be completely wiped out? If the answer is yes, the investment is too risky, no matter how safe the brochure claims it is. The ultimate rebellion in 2026 is financial literacy. It is refusing to be a passive participant in your own economic extraction. When you diversify your tax risk, when you maintain liquidity, and when you stop relying on a single government promise to fund your retirement, you become incredibly dangerous to the system. You become untrappable. I know it is deeply cynical to look at the world this way. It is exhausting to realize that you have to play defense against the very institutions that govern your society. You have every right to be angry about the SGB tax change. It is unfair. It is a retroactive penalty on responsible financial behavior. It is exactly the kind of bureaucratic overreach that makes people lose faith in the system. But you cannot let that anger turn into paralysis. The people who engineered that tax change are hoping you will just sigh, accept the loss, and keep playing their game. They are hoping you are too tired to restructure your portfolio. You have to prove them wrong. Let the SGB trap be a wake-up call. The rules are written in pencil, and the government holds the eraser. Take a hard look at your net worth this weekend. Look at where your money is trapped. Look at your exposure to legislative risk. If 100% of your wealth is locked in government-sponsored retirement accounts or illiquid bonds, you are a sitting duck. Start building your taxable brokerage account. Start buying your agility. The system will absolutely change the rules when you start winning, but if you are agile, diversified, and completely unsentimental about your assets, they won't be able to catch you. Take your power back. Diversify your risk. You've got this. I'll see you in the next one.